Have you ever noticed that every time the Federal Reserve makes an announcement, Wall Street goes crazy? Stocks tumble, mortgage rates change overnight, and suddenly borrowing feels more expensive. Today, we're going to uncover why the Federal Reserve's interest rate decisions affect not just Wall Street, but your home, your car, and even your job. Stay with me, because by the end of this video, you'll understand how one institution can control the price of money itself. All right, so before we dive into the details, let me paint the big picture. The Federal Reserve, often called the Fed, is the central bank of the United States. Its mission is simple in theory, but incredibly complex in practice. Keep prices stable, keep employment high, and maintain financial stability. And the most powerful tool the Fed has to achieve all of this? Interest rates. When we talk about the Fed making a rate decision, we are talking about the federal funds rate, the short-term interest rate at which banks lend money to each other overnight. But don't let the simplicity fool you. This one rate ripples through the entire economy, impacting your savings account, your credit card, your mortgage, and even the global markets. But here's the million-dollar question. Why does the Fed raise or cut these interest rates in the first place? Well, to answer that, we need to talk about the Fed's two main goals: inflation and employment. The goal of keeping inflation low and stable means that the Fed wants to prevent drastic price increases or decreases. Imagine you go to the grocery store and the price of eggs doubles from one week to the next. That's not sustainable, and it's not good for the economy. Likewise, the Fed doesn't want to see the prices plummet either. That could lead to a recession or mass unemployment. It's kind of like Goldilocks and the Three Bears. The Fed wants things to be just right, and interest rates are one of the levers they pull to get there. By adjusting these rates, the Fed influences how much banks charge their customers, which in turn affects how much we pay for loans, mortgages, and even credit cards. Think of it like this. If the Fed thinks that prices are rising too fast, they will increase interest rates to cool the economy down. Higher interest rates make borrowing money more expensive, so people take out fewer loans, buy fewer houses, and spend less money overall. And if the economy starts to slow down, the Fed might cut interest rates to encourage borrowing and spending again. Pretty simple, right? Well, not exactly. Because while raising interest rates can help bring down inflation, it also comes with some potential downsides. For example, when interest rates go up, it can make it harder for people to afford homes. That's because higher interest rates mean bigger mortgage payments. And that's already a problem in many parts of the country where housing prices are sky high. Plus, higher interest rates can also hurt small businesses that might not have enough cash on hand to cover their expenses. In fact, research shows that when the Fed raises interest rates, small businesses tend to cut back on investment, which can lead to slower economic growth and fewer jobs. And that's the last thing we want. On top of that, think about the impact on our wallets. When interest rates rise, credit card companies and banks typically raise their interest rates too. That means if you carry a balance on your credit card, you'll pay more money each month until your balance is paid off. And here's another kicker. When interest rates go up, the value of bonds goes down. And here's why that matters. Many retirement accounts and pension funds invest in bonds. So when interest rates rise, the value of these investments can drop, which means people might have less money saved for retirement than they thought they did. So you're probably wondering, with all these potential downsides, why does the Fed bother raising interest rates? Well, believe it or not, they've got some pretty good reasons. First off, raising interest rates can actually help people save more money. When interest rates are higher, banks pay more on savings accounts and certificates of deposit, CDs. That gives people an incentive to save more of their money instead of just spending it. Second, higher interest rates can also make the US dollar more attractive to foreign investors. That's because when you lend money in dollars, you earn interest on that loan. So if interest rates are higher in the US than they are in other countries, foreign investors are more likely to buy US bonds and other financial assets. And remember, when more people buy something, its price goes up. That means a stronger dollar, which can help keep inflation down. By attracting foreign investment, the Fed essentially uses interest rates to manage the value of the US dollar. But wait, there's more. Raising interest rates can also help the Fed respond to different types of economic crises. For instance, imagine there's a major financial crisis like the one that happened in 2008. In that situation, the Fed might cut interest rates to encourage people to borrow and spend money. That can help prevent the economy from falling into a tailspin. On the other hand, If inflation starts to get out of control, the Fed can raise interest rates to help bring it down. So now you know why the Fed raises interest rates. But what about when the economy is struggling? What happens then? Well, when the economy is facing a downturn, the Fed has a different set of tools at its disposal. One of the most common tools is lowering interest rates. When the economy is struggling, lower interest rates can help stimulate borrowing and spending, which can boost economic activity and help people keep their jobs. The Fed can also inject money directly into the economy by purchasing assets such as government bonds or mortgage-backed securities. This practice, known as quantitative easing, aims to make it easier for banks to lend money and encourage investment. Additionally, the Fed can offer emergency loans to financial institutions to ensure that credit keeps flowing to households and businesses. And let's not forget about the famous helicopter money. While the Fed hasn't resorted to this strategy yet, it's still worth mentioning. Helicopter money involves the central bank distributing cash directly to households or businesses. This unconventional approach aims to put more money in people's pockets so they can keep spending and help the economy recover. Now, it's not quite as easy as dropping money from a helicopter, but you get the idea. Okay, so we've talked about how interest rate changes affect the economy and the tools the Fed uses to adjust them. But what about Wall Street? How do interest rates affect investors and the stock market? Well, here's where things get really interesting. Higher interest rates tend to make borrowing more expensive, which can affect corporate profits and investor sentiment. When companies have to pay more money on their loans, they may earn less profit, which can lead to lower stock prices. On top of that, higher interest rates can make bonds more attractive to investors, which means stocks might seem less appealing. That's because bonds offer a fixed return, which is appealing when interest rates are higher. But if interest rates fall, bond prices go up, making them less attractive and stocks look relatively more appealing. However, it's not all doom and gloom for stocks when interest rates rise. Some sectors like banking and insurance tend to benefit because they can invest in higher-yielding assets. And here's another fascinating aspect of interest rates and investing, the term structure of interest rates. This refers to the relationship between interest rates on short-term and long-term debt. When short-term interest rates are higher than long-term rates, it's known as a normal yield curve. However, when long-term rates are higher than short-term rates, it's called an inverted yield curve. And guess what? An inverted yield curve is often seen as a predictor of a recession. Why? Well, when long-term rates are higher than short-term rates, investors must be expecting something not so great to happen in the future. Otherwise, why would they demand a higher yield on long-term bonds? In fact, every time the yield curve has inverted since the 1950s, a recession has followed. Of course, correlation doesn't equal causation, and there are plenty of other factors to consider, but it's still worth keeping an eye on the yield curve as a potential indicator of economic trouble ahead. And here's a little bonus fact for investors to consider. The strength of the US dollar also tends to increase when interest rates are higher. That's because higher interest rates attract foreign investors seeking better returns on their money, and that increased demand for the dollar can strengthen its value. So when the Fed raises interest rates, it's not just affecting the US economy, it's sending ripples across the globe. You see, when the dollar strengthens, it can make imports cheaper for Americans, but it can also make it more expensive for other countries to buy American goods. And here's where things get really wild. When the Fed raises interest rates, other central banks around the world may follow suit to keep their currencies competitive. That means higher interest rates aren't just affecting the US, they're influencing economies all over the planet. So now you know a lot about how interest rates work, but how can you use this knowledge to your advantage? Well, here are a few tips. First, if you're thinking about taking out a loan, whether it's for a mortgage, car, or personal loan, it's smart to shop around and compare interest rates. You might be able to save thousands of dollars just by getting a slightly lower interest rate. Second, if you're saving for a down payment on a house or planning for retirement, it's essential to consider how interest rates might impact your investments. When interest rates rise, bonds might become more appealing, but stocks could become less so. So it's worth diversifying your portfolio and speaking with a financial advisor. Finally, stay informed. Keep up with the latest news and announcements from the Fed and other central banks. Understanding the broader economic context can help you make better financial decisions. I hope you enjoyed learning all about how the Fed impacts our daily lives. And here's a final thought to ponder. The decisions made by the Fed can have far-reaching consequences, not just for us as individuals, but for the entire global economy. It's a reminder that even seemingly distant events can have a profound impact on our lives. And that's why staying informed and understanding how the financial world works is so crucial. So thanks for joining me on this journey of financial discovery. Until next time, keep learning, keep growing, and remember, knowledge is power.